Between now and January, 10 separate things are going to change for people on Social Security and Medicare. Some of them will be announced. Some of them are already decided and just haven't reached you yet. And 2 of them come with deadlines that, if you miss them, cost you real money. Here's the problem. Every one of these gets covered separately by different people at different times. A headline about the COLA in October, a different headline about drug costs, a letter in your mailbox in September that looks like junk mail. And unless you're tracking all of it, you end up reacting to each piece as it hits you with no sense of how they fit together. So this video is the whole picture in one place. I'm going to walk you through all 10. What's already confirmed, what's still a projection, what dates they land on, and which ones actually require you to do something rather than just know about it. Some of these will apply to you, and some won't, so I'll be clear at the start of each one about who it's for. 2 of these have hard deadlines this year, and I'll flag both loudly when we get to them. And a note on how I'm doing this. I have a longer, dedicated video on most of these topics, linked in the description. What you're getting here is the main point of each, the thing you'd want to know if you only had 2 minutes. If one of them matters to you, go deeper on that one. Let's start with the money coming in. Before the list, put 4 dates in your head, because almost everything I'm about to say hangs off one of them. September. 2 things arrive. Medicare releases its 2027 plan details, and your annual notice of change letter shows up in your mailbox. That letter is the single most ignored piece of mail in American retirement. October, the big one. Social Security announces the 2027 cost of living adjustment, the number that sets your raise. And on the 15th, Medicare open enrollment opens. November. Medicare announces what your Part B premium will actually be. And around the end of October into November, the IRS releases all of next year's tax numbers. December. Deadlines close. December 7th for Medicare enrollment, December 31st for nearly everything on the tax side. 4 months, 4 sets of decisions. Now let's go through what's actually in them. This affects everyone receiving Social Security. Your 2027 raise is calculated from inflation data covering 3 months, July, August, and September of this year. The law compares the average of those 3 months to the same 3 months last year. That percentage difference is your COLA. That's the whole formula. Right now, we are standing inside that window. July's data is in. August and September aren't finished. The Senior Citizens League currently projects 3.8%. AARP projects 3.6%. For comparison, the raise you got this January was 2.8%. If 3.8 holds, that's roughly $74 a month more for the average retired worker, and the biggest adjustment since 2023. Here's the main point, and it's the part most coverage gets wrong. Only 1 of the 3 required readings exists so far. 1 out of 3. The number can still move meaningfully before it's final. Anyone telling you the 2027 COLA is 3.8% is stating a forecast as a fact. And one more thing worth carrying with you, a big COLA is not good news. It's a thermometer, not a gift. A larger raise means prices rose faster on you over the summer. The 8.7% in 2023 wasn't generosity. It was the receipt for the worst inflation in 40 years. The official number comes in October. Higher payments start in January, with SSI a month earlier in December. This one affects everyone, and it's the one that frightens people most. The 2026 Trustees Report projects the Social Security Trust Fund reaches depletion in the fourth quarter of 2032. You'll see that reported as Social Security runs out in 2032. That framing is wrong, and I want to correct it clearly. Depletion does not mean zero. Social Security is funded primarily by payroll taxes from people currently working, and those taxes don't stop in 2032. The trust fund is the reserve on top of that income stream. When the reserve is gone, incoming payroll taxes still fund roughly 3/4 of scheduled benefits. The Committee for a Responsible Federal Budget estimates that if Congress does nothing at all, the automatic reduction would be around 25%. That is a serious number, and I'm not going to soften it. A 25% cut to a fixed income is a real hardship. But notice the condition: if Congress does nothing. We have been here before. In 1983, Social Security faced this same cliff, and Congress passed a fix months before it arrived. I'm not predicting what they'll do this time. I have no idea, and neither does anyone selling you a newsletter about it. What I can tell you is that a projected shortfall 6 years out, with a known precedent for legislative fixes, is a very different thing from the money runs out. One small connection to the last item: a larger COLA costs the system more, which moves that projected date slightly earlier. Both things are true at once. This one is for anyone still working while collecting Social Security before full retirement age. If you're working and claiming at the same time, and you earn above a certain limit, Social Security withholds part of your benefit. In the year you reach full retirement age, the 2026 limit is $65,160, and above that, they withhold $1 for every 3 you earn. There's a lower limit that applies in the years before that, so check the current figure for your situation. Now, here's the main point, and it's the reason this item is on the list. That money is not gone. Almost everyone believes it is. They think the government took it and kept it as a penalty for working. That's not what happens. When you reach full retirement age, Social Security recalculates your benefit to credit you for the months that were withheld. Your monthly payment goes up permanently to account for it, so it isn't a penalty. It's a delay. That distinction matters enormously because people make real decisions on the wrong version of it. People quit jobs they wanted to keep. People turn down hours, all because they believe they're working for nothing. If you've been avoiding work for that reason, you've been avoiding it based on something that isn't true. One related number while we're here: the maximum earnings subject to Social Security tax rose to $184,500 this year, up from $176,101. This is for anyone with Medicare Part D prescription coverage. 2 numbers changed for 2027, and unlike the COLA, these aren't projections waiting on data. They're built into the program. The standard Part D deductible goes from $615 to $700. That's what you pay out of pocket before your plan starts sharing costs. It's more money out of your pocket earlier in the year. The annual out-of-pocket cap on covered drugs goes from $2,100 to $2,400. That's the ceiling. Once you hit it, you pay nothing more for covered medications for the rest of the year. Now, those move in opposite directions in terms of who they help. A higher deductible costs almost everyone a little more. A higher cap only matters to people with genuinely high drug costs, and for them, having any ceiling at all is enormous. Before this cap existed, catastrophic drug costs had no ceiling whatsoever. Insulin stays capped at $35 for a month's supply, with no deductible applied. Recommended vaccines stay free. And one structural change worth knowing, 2027 permanently locks in the redesign of Part D. The old coverage gap, what everyone called the donut hole, is gone for good. That's not a temporary program anymore. It's how Part D works now. This is for everyone on Medicare, and it's one of the 2 items with a hard deadline. In late September, your plan will mail you something called an Annual Notice of Change. The ANOC. It's several pages. It's written in insurance language, and an enormous number of people put it straight in the recycling. That letter tells you exactly what your plan is doing to you in January. Whether your premium is going up, whether your medications are still on the formulary, whether your doctors are still in network, whether your copays changed, here's the thing people don't understand about Medicare Advantage and Part D plans. They're run by private insurers, and those insurers are allowed to change the terms every single year. Your health can stay exactly the same, and your costs can change substantially because the plan changed underneath you. And if you do nothing, you're automatically re-enrolled in the changed plan. Open enrollment runs October 15th to December 7th. That's your window to switch Medicare Advantage plans, change your drug coverage, or move between Original Medicare and Advantage. Changes take effect January 1st. 5 things to check when that letter arrives: your premium, your drugs, your doctors, your total cost rather than just the premium, and whether a different plan fits you better now. And this is important. Free, unbiased help exists. Every state has SHIP counselors, and they don't sell insurance. There's also 1-800-MEDICARE. You do not have to figure this out alone, and you do not have to talk to a salesperson to get help. This is for anyone 65 or older, and for most of you, it's the largest dollar amount in this entire video. Almost everyone in this age group knows about the $6,000 senior deduction that came in for 2025. Far fewer people understand that it's the third layer of a stack, not the whole thing. Here's how it actually works if you're single and 65 or older. You start with the baseline standard deduction, $16,100. On top of that, there's a long-standing age 65 add-on of $2,050. And on top of that sits the newer $6,000 senior deduction. $16,100 plus $2,050 plus $6,000. $24,150 of income shielded from federal tax before you count anything else. Married filing jointly, the baseline is $32,200, and the age add-on and the senior deduction apply per qualifying person. So a couple where both spouses are 65 or older can potentially claim each of those twice. 3 things to know. It's per person, not per return. There's an income phase-out that begins around $75,000 single or $150,000 joint, so higher income retirees get a reduced amount or none. And it sits on top of the standard deduction. You don't need to itemize to get it. And the part that makes this urgent rather than just interesting, the $6,000 piece runs for tax years 2025 through 2028. It is a window, not a permanent feature. Under current law, it expires. I'll say one thing about what this does not do, because there's bad information circulating. This deduction does not change how your Social Security is taxed. The IRS still uses the same provisional income formula it has used for 40 years, with the same thresholds. Those are separate systems. This is for everyone, and it's a date to watch rather than an action to take. In late October or early November, after September's inflation data is finalized, the IRS releases its inflation adjustments for the next tax year. That single announcement contains the 2027 tax brackets, the 2027 standard deduction, retirement contribution limits, catch-up limits, essentially every number that governs your return next year. If you're doing any year-end planning, this is the release that tells you what you're planning against. It lands with just enough time to matter before December 31st, which is not a coincidence. I'll cover the numbers here the day they come out. This is for anyone born in the 1950s or early 1960s, and it is the strangest rule in this entire video. The Secure 2.0 law changed when you're required to start taking money out of your traditional retirement accounts. Those forced withdrawals are called required minimum distributions. If you were born between 1951 and 1959, your required starting age is 73. If you were born in 1960 or later, it's 75. Now, listen to how that boundary works, because there is no gradual phase-in. Someone born on December 31st, 1959, starts at 73. Someone born the very next day, January 1st, 1960, starts at 75. 1 day apart, 2 years of difference. There was enough confusion about people born in 1959 that the IRS had to issue regulations specifically clarifying that the 1959 cohort uses age 73. If you were born that year, that's your answer. And here's why this matters beyond trivia. If you're in the 1960 and later group, you now have the longest gap in modern history between when most people retire and when withdrawals become mandatory. Those in-between years, when your income is low and nothing is forced, are the cheapest years of your life to do Roth conversions or reposition money. That window closes on its own, quietly, and it does not reopen. This is for anyone already required to take distributions, and it's the second hard deadline in this video. If you're at your required age, you must take your distribution from traditional IRAs and 401ks by December 31st. Roth IRAs are exempt entirely. Roth 401ks are exempt while the original owner is alive. The penalty for missing it is 25% of the amount you failed to withdraw. Not 25% of the tax, 25% of the money itself. It drops to 10% if you correct it within 2 years and file the right form, but the headline number is 25. 2 things people get wrong every year. First, the first-year trap. In your very first RMD year, you're allowed to delay until April 1st of the following year. It sounds like a favor, but your second distribution is still due that December, so you end up taking 2 in 1 calendar year, doubling that income and potentially pushing yourself into a higher bracket or over a Medicare surcharge threshold. Sometimes delaying is right. Often it isn't. It's a decision, not a freebie. Second, and this is the one worth acting on, if you're 70 and a half or older and you give to charity anyway, you can send money directly from your IRA to a charity as a qualified charitable distribution. Up to $111,000 per person this year. It counts toward your required distribution, and it never enters your income at all. Think about the difference. Write a check to your church and claim it as a deduction. If you take the standard deduction, that does nothing for you. Send the identical amount as a QCD, and it satisfies your RMD, stays out of your income, and lowers the number that determines how much of your Social Security is taxed. It has to go directly from the custodian to the charity. And if you've already taken your distribution as cash, you cannot go back and convert it. It is the sequence only runs one way. December 31st. Not April. December. Last one, and it's the one most likely to be sitting unclaimed right now. If you were married for 10 years or more, you are currently unmarried, and both you and your former spouse are at least 62, you may be able to claim a benefit based on their earnings record. Up to 50% of their full retirement age amount. Let me answer the two questions that stop people cold. Does it reduce what your ex receives? No. Their benefit is completely unaffected. Will they be notified? No. Those two fears are why an enormous number of people never even ask. And I want to be clear about the practical reality. You receive the higher of your own benefit or the spousal amount, not both added together. So, if your own earnings record is strong, this may not change anything for you. But if you spent years out of the workforce raising children, this can be the difference between a small check and a much better one. One more thing on this. The Social Security Fairness Act, which took effect in January of 2025, repealed two provisions called WEP and GPO that had reduced or eliminated benefits for people who worked in certain government jobs with a pension. Spouses and survivors were hit hardest by those rules. Retroactive payments have been going out, averaging around $6,700 per person. If you were ever told your spousal or survivor benefit was reduced or zeroed out because of a government pension, that situation has changed, and it's worth a call. Let me hand you the whole thing as a calendar. September. Your Medicare ANOC letter arrives. Read it, don't bin it. Medicare's 2027 plan details are published. October. The COLA is announced. Expect something in the 3.6 to 3.8 range, but only one of 3 data readings exists so far, so hold it loosely. October 15th. Medicare open enrollment opens. November. Your actual Part B premium is announced. Currently $202.90, projected around $209.50 for 2027, with some private forecasters expecting higher. The IRS releases the 2027 tax numbers around this time. December 7th, Medicare open enrollment closes. December 31st, your RMD deadline and the cutoff for QCDs and nearly every year-end tax move. January, your new benefit amount arrives. Check whether it changes your tax situation. 2 of these require action from you, and only 2. Review that Medicare letter before December 7th. Take your RMD and consider a QCD before December 31st. The rest is information, useful, but not urgent. If I had to give you one single task from 25 minutes of this, if you're 65 or older, look at your last tax return and confirm all 3 deduction layers were actually claimed. That's the largest dollar figure in this video, and it's the one most likely to have been missed. Important note: this video is educational information only, not tax, legal, or financial advice. IRS Tax Guide USA is an independent channel and is not affiliated with the Social Security Administration, Medicare, the IRS, or any government agency. Some figures here are projections that will change, and rules vary by individual circumstance. Verify everything at SSA.gov, Medicare.gov, and IRS.gov, and speak with a CPA, an enrolled agent, or a SHIP counselor about your own situation. If any one of these 10 mattered to you, I have a full video on it. Links are in the description. And there's a timestamp for each item in this one, so you can jump back. Subscribe if you'd like these covered as they happen. When the COLA number drops in October, and when the IRS releases the 2027 figures, I'll have both here the same day. And tell me in the comments, Which of these 10 did you already know about, and which one caught you off guard? Whichever one gets named most, that's the video I make next.